Welcome, everybody. Tonight we've got the privilege of having Scott Andrews giving a presentation on using gaps with the candlestick patterns. So this is good information because it takes candlesticks and kind of fine-tunes it for us. So
that white
Scott,
13,
welcome to the Candlestick Forum. We're anxious to see your information.
White 13, 100 tick, back in cloud. Sell stop cancel.
Thank you, Steve, and
hopefully
everyone can hear me okay. If I need to adjust
moving average.
the volume, let me know, but you should be able to adjust the volume on your end. I'm delighted to be here tonight with Steve. Steve actually wrote one of the first 3 trading books I ever read. I was fortunate enough to take a company public in the 90s, in the dot-com boom, and make a little money and sort of seal my interest in the markets. And when I started trading, I was fortunate enough to pick up his profitable candlestick trading book, and it has been influential over the past 10 years. I still use candlesticks in my trading.
13 price
You're going
crossing
to
under
see
8 bar,
a bunch of
moving
information on them tonight. In fact, a lot of this should be familiar with you, being friends of Steve's and followers of Steve's. I think he calls them 12 major candlestick patterns. Probably the only thing I disagree with him is that I counted 16, but maybe it's the way I did it. It's probably just a classification thing, but there's actually 16 patterns I'm going to show you research on. So not my opinion. I'm not as experienced as Steve, and I haven't been trading for 30 years. I've been trading intensely and full-time for 10 years. I spent some money, got a mentor, spent a full year with him, and I learned how to trade options. Swing trading, and I did some day trading as well, but mostly swing trading options and using indicators. Unfortunately, he did not teach anything about candlesticks. His whole approach was to use multiple complementary indicators stacked one upon another on a chart, and then when they all crossed in either direction, that was a buy or sell signal. And it looked great on paper, and in reality, actually, took a small 6-figure account and made 6 figures my first year, and I was convinced I was God's gift to the trading world, and that maybe I needed to move to New York because I just had it, as they say. And sadly, I realized reality when the market stopped going up in 2003. 2003 was a big bull year. My call option strategy stopped working, and the market went sideways, and I didn't know what I was doing. And of course, I just doubled my position size and account size, both. And in 10 short weeks, I gave back almost all of the accounts, 98% of my accounts. So for all intents and purposes, I was back to square one roughly 15 months after I started out. So I realized real quickly that I needed something other than subjective or discretionary interpretation that this gentleman was teaching in order to get an edge in the markets, because I didn't have, and he was the real deal, I just didn't have the years that I needed to master the interpretation of those indicators. They were not as simple as what Steve teaches and what perhaps some others teach. So for me, coming from having an engineering degree, coming from West Point, being very math-oriented, the only answer was to dig into the math and to study what has happened in the past that may give insight to help predict the future. So I ended up focusing on the opening gap because 70% of all opening gaps were retraced back to the prior day's close. I knew there was a large percentage, but that's what the math shows. And using historical analysis to guide all my decision making. So I am not a very discretionary trader. That's just a trade mathematically, is sort of the way I think of it. So without much further ado, let me just tell you, I can promise you over the next hour, I'm going to share a ton of information. I'll show you how to get a copy of the slides here in give me just a couple of minutes, and you can, in fact, I can post this now. If you want to take notes on them, you can actually download them and print them out. Lots of facts, lots of accurate information. I personally conducted all this research on my own. I'm going to actually share the formulas, at least the conceptual formulas, so you know exactly what I tested. So it's not exactly the way Steve defines all the candlestick patterns, how to loosen the parameters in order to increase the sample sizes. And I think I can fairly safe to assure you, because I've done this presentation in the past, you will find it helpful if you keep the big picture in perspective. That's really what I want to share. Even though I'm going to share a lot of nitty-gritty detail, I want you to think about how to use this information with your own trading. And I got one other fact, or one other thing I can promise you. It will not be funny. Because I'm not a funny person, I will be done in about an hour. Okay. Now, I'm happy to go longer if there are questions, but we should be able to wrap things up in roughly an hour. And my goal is to introduce you to probabilities and how to use gaps in your day in swing trading. So if you have questions, feel free to fire away. I'll do my best to answer them. I prefer that they be related to the slide that I'm on. If they're not, for continuity purposes, I'm just going to keep going, and you can repost it or re-reference it later at the end of the session. Now, I am going to be sharing research that is actionable information, meaning you're going to be able to look at some of this information, and you're going to want to trade solely based on some of it. Some of the data is very compelling. I just encourage you to remember that the past is not a perfect predictor of the future. In fact, my general rule of thumb is a given day about 2/3, 3/4 of the time. 1/3 to 1/4 of the time, the market just does its own thing. So it's not helpful in those situations. In fact, my historical win rate has been about 65%, and that's through a wide range of market conditions. And I'm actually proud of that. And my average win is a little bit smaller than my average loss. So I do risk a little bit more than I stand to make. I'm a day trader, and I'll get more into that in a bit. But really, I just want to use this information with your eyes wide open. Okay, never bet the farm, as they say. Oh, hold on, folks. Yeah, that's the wrong link. Let's try that again. It is masterthegap.com. I don't know what happened. /candlesticks. masterthegap.com/candlesticks. Okay? That'll take you to www.masterthegap.com/candlesticks. That'll take you to the page to download the slides. Really sorry about that. All right. So we'll cover gap basics. I want to make sure we all have the same basic understanding of what is a gap and what's not in the terminology I'll be using. We'll talk about the gap trading history of the major patterns, specifically showing you research. I'll be using the spider as my example. I'll discuss very briefly how I trade gaps and show you how you can get some more information if you're interested. So there's the link. You may need a www in there. Probably does need the www.masterthegap.com/candlesticks. All right, so what is a gap? I believe the most common definition, and the one that I use, is simply the difference between a security's opening price and its prior day closing price. And the difference shows up visually on a price chart as an open space or gap. There's a couple of my cuties. I have 4 little cuties that have various gaps in their teeth because they're all somewhat young and in that tooth losing age. On a Q's chart, here's a Q's chart, daily chart. These are common gaps. If you look closely, you can see gaps up that filled, trading back to the top of a green candlestick or down to the bottom of a red candlestick. But you can see these open spaces here. Those are unfilled gaps. These are unfilled up gaps, actually. So this is probably breakaway gap, continuation gap. The names don't really matter much to me, since I'm using the math to predict when scenarios are likely that we'd get a breakaway gap or gap that doesn't fill. That's what a gap looks like on a daily chart. A little bit closer inspection, this is actually going back a few years, but this is the Russell. We have a gap down, top of the red candlestick. It actually trades precisely to the close of the prior day, which is 48.38. This is way back, actually, pricing-wise. That may have been 2008. Doesn't matter. Anyhow, fills the gap and then rolls over. So that's an example of that would have been a scary gap trade, if you will, if you were depending upon which direction you were going in. So on an intraday chart, 5-minute chart, this is what they look like. So this is, I wish they all look like this. They don't. Gap up, works its way down all the way to the blue line, which is the prior day's closing price as of 4 p.m. Eastern, 3 p.m. Central. And that's considered to be a gap fill. About 70% of all opening gaps will do this, at least in the indices. Within an individual stock, the numbers could be much higher or much lower depending upon whether or not it's in a consolidation phase or a momentum phase. All right, so fading the gap. I am a gap fader. If you're not familiar with the term, that means I buy down gaps if they're historically attractive or they're set up in a way that's been historically attractive, or I will short up gaps if they're, again, historically attractive. So I'm fading or going the opposite direction of the prevailing overnight move, right? It's that overnight price action of the futures that creates the gaps and then it's indices. This one pushed the ES way down, Jesus, a long time ago as well, down around 900. And it meandered back and forth most of the day before finally around 3 o'clock or 1500 military time, filling its gap. So that would have been a successful trade depending upon the size of your stop. But this is fading the gap, going the opposite direction. If the gap had been up, you would short it. So the research I'm going to show you is based upon the SPY, or specifically the SPDR, the S&P 500 ETF. 10 years of data, about 2,500 trading days, session times from 9:30 a.m. to 4 p.m. And I'm only considering gaps of at least 10 cents in size. So 10 cents, my minimum gap. In fact, I day trade the ES futures. I'm looking for 1 point there, a minimum of 1 point. Or if you want to trade the Russell futures, a half a point, for example, or maybe the YM would be 10 cents. 10 points, or the diamonds would be 10 cents. So I'm entering, all the testing I'm going to show you is based upon entering at 9:31 a.m. in the SPDR. Now just as a note, I enter futures at 9:30. But to make the testing more accurate, for a reason I won't go into, want to make sure there's volume, I assumed that you entered at 9:31. So wherever the market was at 9:31.00, that's a.m. Eastern time, then I would short an up gap or buy a down gap, targeting the prior day's close as of 4 p.m. and exiting at the end of the day if the gap did not fill. Commissions and slippage per trade not included. I'm not trying to show a strategy per se, so you'd want to discount these numbers a little bit. Commissions really don't account for much. A slippage really isn't a big deal when you're trading the gap, for example. If you're scalping or doing shorter time frames, then obviously that'd be more important to pay attention to those. And again, folks, on the link, I blew it. Sorry about that. It is James C. posted 810, www.matchthegap.com/candlesticks plural. If you want to copy the slides, I'll show it again at the end as well. All right, key terms. I'll describe what fade is, to go in the opposite direction of the opening gap, and filling the gap is when price retraces from the open to the prior day's closing price. Win rate is I'm going to show you in all these slides. We'll show win rate and profit factor, or PF. Win rate is the percent of trades that hit their target gap fill without first being stopped, which in this case there is no stop other than the end of day stop, or finish the day profitable. Right? Some gaps won't fill, but will finish inside of their opening prices, making them profitable. And that's considered in this win rate. And again, the average is, as I'm about to show you, just shy of 70% in the SPDR. And then profit factor is the ratio of historical profits, just gross profits from the winning trades, from the gross losses from the losing trades. So by definition, anything greater than 1 has made money historically. The bigger the number, the better. So for example, you'll see some of these slides, some of these setups have historical profit factors of 2. And 2 means it's made twice as much as it has lost. When I entered questions, do I put it in a limit order or market order? I enter all gap trades at the open with a market order. There's a lot of volume that comes in at the open because I'm going the opposite direction of the prevailing overnight move. I often do not have slippage at all. I actually enter 1 second before the open, to be very specific. Occasionally we'll actually have positive slippage. Sometimes I'll lose a tick or two of slippage. How would this have worked on the S&P today of S&P Mini? Depending on your stop size, the gap did fill. We can get to that maybe at the end of the presentation. I'm happy to pull up some slides of actual live charts. So this is very research heavy. It's probably better to save that question. The gap did fill today. I did not fade it. I was very close to fading. It was a small gap, and the futures were gapping in different directions. So I don't fade small gaps in different directions. All right. So here's the end of the day data I was talking about. The ES is actually just over 70%. I'm not sure why. It's probably because it goes an extra 15 minutes. The S&P 500 futures, the ES, trades until 4:15, where the spider in my research here closes at 4 p.m. Eastern Time. This assumes an end of the day stop or end of the day exit. So again, fading the open. If the gap is up, you short it. If the gap is down, you buy it, targeting the prior day's close. And if it doesn't hit the prior day's close or trade at the prior day's close, closing it at the end of the day. And you see, and this is only gaps greater than 10%. So 68% fill. That's one of the reasons I'm a gap trader. That's my bread and butter. I think it's the best setup of the day for any day traders, intraday traders. It's the only setup I'm aware of that has a built-in strong historical bias to doing something just by definition, because big money doesn't want to chase up gaps, nor do they want to chase down gaps, depending upon which way they're trying to get positioned. So they're going to do the opposite, and I'm trying to ride on the coattails of big money. Gaps greater than 10 cents in the spider. So this ignores any gaps smaller than 10 cents. I only trade gaps in the indices personally. I used to trade gaps on individual stocks. And if you think about the S&P 500, over the course of time here, there have been entire sectors in individual stocks that had win rates for long stretches of time, months of time, maybe even years, but certainly months, of greater than 80%, while there have been other sectors that were filling the gap at rates of 50 or 60%. So if you want to do the extra work and pay attention to what's sort of working, what's not, you can do very well trading gaps on individual stocks. I just found that the extra work wasn't worth it to me. Plus, I really love the leverage of futures. They're clean, they're liquid, they're simple, they're tax efficient. There are just so many advantages of futures. When you have an edge, you want to exploit it, and I think for me, it was a superior choice. So I trade the indices. And the indices, think about it, by definition, are going to be tougher to break away. It's going to take a really strong piece of economic news or some other piece of news to result in the markets moving on light volume overnight away from the prior close, and then that price never trading back to its prior close, meaning it continued in the direction of the gap. That only happens a third of the time, 30% of the time, as this chart here shows. So I like the fact that the indices are more consistent gap fillers, and I don't have to worry about figuring out which sector or which stocks are working best right now. And so, yeah, a lot of great questions here. Let me do the best I can here. What this chart shows is long trades. So this would be a down gap. So I'm a gap fader. Remember, I'm fading the gap. So a gap down, I buy it. Targeting the prior day close. That's considered a long trade by TradeStation. The gap is up. It assumes you shorted it. Target the prior day's close. This is just a snapshot of what if you had faded every gap over the past 10 years. This would have been your results. You wouldn't have made any money. I'm not here to show you that this was to make money. This is all about showing the average win rate of all gaps. What I'm going to do is that we're going to delve into this 2,000 or so trades and look at 16 different candlestick patterns and what the results of fading those gaps were. This is geared. Well, this is really a lot of swing traders get a lot of value out of this. You can use information I'm going to show you several different ways, and I'll get to that in just a moment. So swing traders and day traders, I think, will get quite a bit of benefit out of this. The link sends an email which leads to a subscription service. Can you download without doing the subscription? Now, you're not subscribing to anything. You're providing your email. We will send you the slides, and we'll send you a couple follow-up emails so you can learn more about gap trading and probabilities. You can always unsubscribe at the very bottom of it, but you're not paying for anything. How can I say this? The winning strategy will lose are so much larger than the winners. Again, folks, this is just a snapshot of trading all gaps. I would never, ever suggest you trade all gaps, okay? A winning strategy is one that doesn't really matter on the win way. It's all about making money, right? Profit expectancy. So it's the only thing that matters is what's the odds of having a winner and the size that I expect to win minus the odds of having a loss and the size of the expected loss. That's what I live and breathe by every single day. Don't get too muddled in the details here. We're looking at big picture. 70% of gaps fill. That's a good thing. You want to keep that in mind if you're a swing trader or a day trader. Because if you're a swing trader and you're long and the gap is down, should you panic? Maybe, but probably not. 70% of the time, prices are going to work their way back up to the prior day's close, giving you a much better opportunity to get out of your position if you want to get out versus panicking at the open. And that's what I'm going to try to show you, okay? So be patient. I've got a lot of great information here. Focus on the big picture. This is being recorded. You'll get a copy. You can download the slides and all this research I'm about to share with you. So the definitions I'm going to show you are based on Steve's definitions. I have loosened them, made them more liberal to increase the sample size results a bit, okay, so that it's more valuable information for you. The concepts are still going to be helpful. The definitions here, I'm not going to go through them all, but you can reference this when you download the slides, being either above or below the 10-day moving average. I could have used, and maybe I should have used, the 8-period EMA, which is the T-line that Steve uses, but I've always used a 10-day moving average, so that's a 10-day simple moving average. That's what I use. So, again, you can reference these, but generally all of them either above or below a 10-day moving average. And then they're generally in line, not generally, they are completely in line with Steve's definitions. I just had to make some judgment calls on, what's the definition of a doji, for example. Doji to have enough trades to make it realistic in my mind, the one I've always used, if it's price open and close within 10% of one another. So use this information to improve your position entries, right? If you're trying to get long, there could be opportunities where, maybe you'll see there's a doji in the bottom of a downtrend, you gap up, and I think Steve would tell you, you want to get long. Well, I think you'll see in some of this data, you might want to wait because price has a good chance of getting down to the prior day's close. So get long that day, but maybe you want to wait and put a buy order at the prior day's close and so on. You can do the exact same thing with your exits. You can use this information for intraday trading, which is all I do. And you can use it with the spider or other indices. All the indices, the Russell, the Dow, the NASDAQ, are all highly correlated, as well as individual stocks. Just be sure that the stock you're trading, you want to know that it is correlated. And also, I see that the attendee chat is now disabled. I appreciate it and understand that I was getting too bogged down in questions. But I prefer that the attendees be allowed to ask questions, if you don't mind, whoever's running the chat right now, and I'll do a better job of trying to ignore them until the end. How about that? Because I did, in fairness to the attendees, thank you, say that they could ask questions. So, and I love questions, and that's my own fault for getting bogged down in it. But let me power through this stuff, and what I want you to ask, let the questions be focused on the slides we're on. I'll do my best. I don't mind repeating myself once on each slide, whatever I have to, so you understand the information. And then at the end, we'll have time for some further questions. I don't mind staying later than an hour if need be. Okay, so let's get to the patterns. The doji in an uptrend. Uptrend means above the 10-day moving average. A doji, as I've said, was open and close are within 10% of one another. These represent candlesticks. couple things stand out here. Odds after a doji and an uptrend favor a gap down a little bit, right? Maybe 20%. Historical win rate is identical. So the odds if you get a gap up are trading all the way back down to the prior day's close, 70%, just dead nuts, pardon the expression, of same for down gaps. However, the money's been made. The average win size, it's almost 2 to 1 here with the profit factor. The way the profit factor works out here, 1.9. So generally speaking, if you see a doji and an uptrend above a 10-day moving average, it's a pretty good bet to short the next morning, targeting the prior day's close. So if you're looking to get swing short, one way to do it and get some tremendous entries where you can leverage your position size and not risk as much, right? You need to work into your position sizing based upon how much you're risking. Well, you can go short on short with a smaller stop following an up gap that followed a doji, right? Because if you're gapping up here, you can use a smaller stop, get it, whatever, 10 points, $1 above your open, and get position and allow you to really use a bigger position size for possible reversal. Down gap has a 70% win rate, but the way the math works, a lot of these will run against you. That's why the profit factor is 0.8. So I think in general, Steve would tell you, down gaps looking to get short. That's a fine place to get short. Just know 70% of the time they could go back up to the prior day's close. That may be a better opportunity to get short. If you get a gap up, you want to short it. Folks, we'll get more into what I use later. I just want to focus on the research here and the information I'm sharing, okay? So Doji's in a downtrend. A couple things stand out here also. 2 to 1 probability of gapping up. You see a Doji, when the market's below a 10-day moving average, 2 to 1 probability of gapping up. Any overnight traders, or if you want to get positioned early in the futures, 2 to 1 probability of gapping up the next day. And it's you lose a little bit in win rate. It's pretty much what I call a neutral scenario. Still have a 65% chance of coming back to the prior day's close. So say it's a really large gap. Well, maybe you don't want to chase the market. Big money doesn't want to chase. You use a smaller position size to get positioned on a swing trade or a day trade to the long side, but you save some. You do that at the open. You save some to buy if the market happens to get down to the prior day's close, because 65% of the time it has. Gap down. You can, same concept, just the inverse of what I just showed you in the prior slide. You can buy a down gap and it would have made money historically. Another opportunity to possibly get positioned for a swing trade with a bigger position, because you can get away with a smaller stop. Bullish engulfing pattern. Pretty self-explanatory. Green candlestick engulfs the red candlestick. Not necessarily the whole body, just the green candlestick engulfs the red candlestick. I was surprised, but in the S&P, fairly rare. And bullish engulfing by definition could be in a downtrend below the 10-day moving average. Not a whole lot to tell here, other than it has a downward bias. Now, I can tell you firsthand, because all I do is crunch numbers pretty much every day and have done so for years. But most engulfing patterns are outside days. Outside days have strong downward biases for reasons I'm not quite sure of, but it's interesting. Whether the gap is up, has a good bias for filling following an outside day, gap is down, it's has a lower chance of filling the gap by the end of the day. So this bullish engulfing pattern certainly confirms that. So in general, you see a bullish engulfing pattern below a 10-day moving average. Don't get too bullish too quickly, because it's probably going to fill its gap before it continues in its direction. Bearish engulfing, just flip-flop, right? You're above a 10-day moving average. Staggering number here. 90% of the time, the market gaps up after a bearish engulfing candle. Anybody remember what the markets, what we had yesterday in the markets? A bearish engulfing pattern, right? We had a red candlestick that engulfed the body of a green candlestick. Which way do we gap today? Loaded question. Up. Wasn't a big gap, but it did gap up. And spent most of the pre-market up as well. So should you panic if you see a bearish engulfing pattern and you are long? Do you want to panic and and close out when you see that it's going to close the end of the day with a bearish engulfing pattern? Probably not, because you probably have a better opportunity to get out at a higher price the next day if you wait. That's the way I interpret that. Question is, why do I use 10 simple moving average versus a fib like 21 SMA to do my research with? Most of the money managers I've spoken with used an 8 or a 10 versus a 21. It doesn't really matter, Gary, what you use. The key is to be consistent. There are no magic indicators, by the way. I hate to break the news, but it doesn't matter if you use a Fibonacci number or you don't use a Fibonacci number. Some of the Fibonaccis are self-fulfilling, pivots and so on, so I pay attention to them for that reason. But mathematically, it doesn't really matter. I like the 10. I've done a lot of testing with, I've tested every single moving average from 1 through 300, literally everyone, run optimizations, and there's not a whole lot of difference in them. They're pretty linear as you get around them. I like to use a combination of short-term moving averages and larger-term moving averages. But let's keep going on the research. Whoops. So a hammer. Hammer comes in a downtrend. I've defined as simply being below a 10-day moving average. And odds favor a gap up after a hammer. And you can see, even though there's still a high probability of gap fill, it has not made money. That average win size is small versus the odds of it running against you. So after a hammer, that's a bullish scenario. The bulls are going to be enthused the next morning. Odds still favor gap fill, but probably going to continue higher after that. A down gap, 74% win rate. But it's, from a day trading perspective, using end of the day stop, again, not what I recommend. It's just a simple test here. Hasn't made you any money. No natural profitable bias for making money. Hanging man. 50-50 on which way you gap after a hanging man. So hanging man is just like that hammer, except for it's above a 10-day moving average. And interestingly, during a bullish market, up gaps have a lower than normal win rate. It has about 10% lower probability of filling its gap than on other days. I guess same scenario. The trend is likely to continue, more likely to get a continuation gap, and has not made money shorting. So this one surprised me a little bit. Down gap after hanging man, no surprise there. Still get a decent chance of filling the gap, but you're not going to make much money. So what this is telling you is that don't panic on a gap down. If you want to get out, maybe sell some at the open and hold some for gap fill, the prior day's close. But bottom line, from a day trading perspective, you don't want to be trading gaps after a hanging man. Piercing pattern. Down gaps are much more likely. Now, some of these have small sample sizes, and it's my instinct. I can't change that. I'm just showing you factually what the data shows when I ran 10 years of back testing of 2,000 gaps with these patterns applied that I just defined for you. So this particular piercing pattern, remember, must be a green candlestick that closes in the top half of a red candlestick, and it's below a 10-day moving average. Odds greatly favor a down gap. The cool thing here, and I've witnessed this, and I think this, I'm confident, even though the sample size is very small here, down gap is a pretty safe bet because these bulls have shown up, and they're going to, unless it's a large gap. In fact, here's a great tip that's not included anywhere on these slides, so you may want to make a note, or at least a mental note. A simple way to determine the another filter, if you will, for determining the odds of gap fill or not is gap size. I've done a ton of testing on this, and it works in a wide range of commodities, equity, stocks, and so on. If the gap is greater than 40% of the 5-day average true range, 40% of the 5-day average true range, then its odds of gap fill go down substantially. I'm not sure why it's that level, but mathematically it tends to be a pretty significant break. So for me, I generally trade only the small and mid-sized gaps, and that has to be a fantastic setup for me to trade. By the way, a fantastic setup would be like a Doji in an uptrend, and you get a gap up. Yes, I'll trade an extra large gap in that scenario. But generally speaking, you'll be better off trading the smaller and mid-sized gaps if you're looking for gap fill or trying to determine if gap's going to fill. So, yeah, down gap is good here. But if you had a gap that was like 40% of the 5-day average true range down, so you had a sizable gap down, that's a much riskier trade. So just gap size, use 40% of the 5-day average true range. You can Google true range, and then you just average it over 5 days. And true range is just the difference between the high and the close, inclusive of any gaps. So in this case, it would just be the high to close. But if we gap down the next day, let's say you opened here and finished way down here, you would take the low of this day and go all the way up to the prior day's close, and that would represent the true range for the days, inclusive of that overnight price action. Average that up for 5 days, take 40%. That becomes a magic line in the sand for me, both up and down, increasing my odds for fading the gap if it's small or mid-size. Generally speaking, yes, it is better to trade smaller mid-sized gaps with a fading strategy. But let me give you one caveat. That is based upon the fact that I don't trade many different setups or many different markets, so I'm very, and I'm very human on top of all of it, unfortunately. So I'm very sensitive to win rates. I don't personally do well trading psychologically when I'm trading a strategy that has a 60% or less win rate, because the odds of multiple successive losses in a row go way up. So, for example, a 50-50 win rate strategy is going to have, over a course of 50 trades, you've got a 76% chance of having 5 consecutive losses in a row, or 95% chance of having 4 consecutive losses in a row. And I try at all costs on all my strategies to avoid 5 consecutive losses. So generally, I may have 4 consecutive losses once every year or 18 months. Most of my strategies, I'm 65% or so. So by doing that, you can back into your win rates by adjusting your stops, using big enough stops to keep your win rates high. That means I risk a little bit more than I stand to make, but I can still make very good money because for example, if you're right 2 times out of 3 and your average winner is 80% of the size of your average loss, you're making a lot of money. So you can do the math on that on your own. So for me, that win rate keeps my head in the game, keeps me committed to my strategy, keeps me from tinkering with the strategy over managing the strategy. And that's very important for me. Continuing on, the dark cloud, just the opposite of the Pierce. All of these are pretty much flip-flops of each other. The dark cloud, red candlestick that closes in the bottom half of a green candlestick. Again, small sample sizes. Odds just inverse what I just showed you. Odds favor a gap up in this case. Right? So piercing pattern favored a down gap, so in the direction of the prevailing trend. Same with the dark cloud. Gap up, and it too also has a high probability gap fill. So another opportunity to maybe get swing short if you think the move may be over. Bullish Harami, green candlestick, inside day, inside of a red candlestick. Odds favor a gap down in the direction of the prevailing trend. You'll notice that. This is below a 10-day moving average. All of these, if you see it pointing down, by definition, all my research, as I explained earlier in the presentation, it's below a 10-day moving average. If you see these lines going up, it's above a 10-day moving average. That is the key filter. And down gaps have been very profitable. Great setup here. Decent sample size. We're an up gap. From a day trading perspective, not as attractive. And here's the other thing. I know many of you are not day traders, but you're swing traders. You're saying, well, Scott, what's the big deal here? So it's got you get a gap down. Maybe I want to get swing long, or but I'm not going to make money just going for the prior day's close. Correct. But what this is telling you, remember, this PF is profit factor, ratio of profits to losses. So the average win, the average move from that down gap up to the prior day's close versus the average move away from the open, it's 2.2 times bigger to the upside. So it's just not prone to running against you a whole lot. So if you're a swing trader, again, you can trade more aggressively, not risk as much, and even get yourself in a position where, I don't do much swing trading really at all anymore. But my thought process was always, if I could get myself in a position where I could basically make my profits equal to roughly the size of my stop in a single day, the day I entered the trade, that was gold, right? So if you could get a position where you get long on a down gap following a bullish Harami, and you can make, say, $1 on the spider by filling that gap, you can take half your position off, thereby locking in a scratch trade worst case. The other half of your position, you can have a stop, equal to the size of your profits. Of course, that's a perfect world. You could gap down beyond and have maybe cause you lose a little bit more, but that's the concept. Question is, why do I not swing trade anymore? Because I'm trading based upon math, I needed larger sample sizes, so a lot of the swing trades don't happen frequently, and I'm not a big believer in what worked 30 years ago works today. I think some of it certainly holds true. There's no doubt, candlesticks have worked for 400 years and so on, but I just have more confidence in trading data that's only 10 years old, and the sample sizes were too small. That's one thing. Secondly, learning curve. I needed to iterate and learn and trade more frequently. Thirdly, I'm not a very patient person, so I just like the idea of trading once or twice a day on the best high probability setups and holding no overnight risk. That's the fourth reason. I did not sleep well when I had large positions in play in the market overnight. So that's why I migrated to day trading. Plus, the leverage of the futures is just a beautiful thing. It allows me to turn my capital way more frequently than just swing trading. And I think it's a little bit easier personally, but that's just me. All right, Bearish Harami, red candlestick inside of a green candlestick. Same concept, an opposite direction of the prevailing trend. This is a flag. Go ahead and get short. You probably got a really good chance, 85% chance of filling the gap, possibly getting positioned for a bigger move to the downside. And a down gap is definitely more problematic. Sorry, there's another question on the price slide. Down gaps are profitable after bullish Harami if you do what? If you buy them. So you buy a down gap. So I'm a fader. Remember, all of this is based upon the concept of fading the open. That's what big money does. Big money on the indices, at least. I know many of you are trading individual stocks and momentum patterns and breakouts, and you're following the gap or going with the gap. Big money doesn't do that on the indices. Indices are great mean reverting instruments. So I'm fading everything. A down gap I buy. 76% chance you will make money targeting the prior day close using an end of the day stop. With the indices, you'll be much happier with your results if your general gap trade is a fade and not a follow. Because remember, as I mentioned earlier, it's really hard for a single bit of news to drive the markets in such a fashion that you don't even fill that given day's gap, because you've got all the different sectors competing in play. So it's just 70% of equity indices gaps will fill that day. All right, Morningstar, another unique pattern. Doesn't happen much on individual stocks, but and if they do, and that's a bullish pattern, you got a good chance to wait and be patient back to the prior day's close, at least on the small sample size. Evening Star, it also favors, a little bit ironically, because both of these favor up gaps, right? Even though one is this is below a 10-day moving average, and the Evening Star is above a 10-day moving average. Again, small sample sizes. You've got to be real careful gleaning too much from any of this and overinterpreting it. Bullish Kicker. I think I've heard Steve say that Bullish Kicker is one of the most reliable of all patterns. You basically get a green candlestick that goes the exact opposite direction of a prior red candlestick, and they open basically in the same levels. Up gap after Bullish Kicker is definitely problematic. It's only a 50-50 kind of trade. Down gaps can be problematic as well. They're more neutral, I would say. Bearish Kicker. Interestingly, because I think the reason for this one is because the markets have a general bullish bid, right? is a down gap after a bearish kicker has done well, surprisingly well historically, and a gap up hasn't done poorly either. So bearish kicker in general can trade in either direction. Can I explain what an up gap and down gap is? All I'm talking about is where the market opens at 9:30 a.m. Eastern Time relative to the prior day's closing price. If you download the slides with some of the links that have been posted, you can go back. I've covered that in the earlier part of the presentation, and hopefully those slides will help you out. Shooting star, basically an inverted hammer above a 10-day moving average, strongly favors a down gap. Bears have won the day there. The trend is still up. You're going to get a gap down, and a down gap probably going to get some more speculative sellers and folks selling, closing out their long positions. Where a gap up, it's a very good setup for shorting. Kickers don't know what the bullish. My research, I'm just showing you what you can interpret it however you want. My view of this is that following a bullish kicker, an up gap, it's 50-50 on trading back to its prior day's close. That to me is, that's lower than average. So that confirms that a bullish kicker is indeed a bullish pattern. You want to be getting long, as I've heard Steve say. Where a bearish kicker, probably not as bearish. Because the markets have a bullish bias. You've got time. Now, this doesn't mean the market's not going to roll over after it fills the gap. It just means that odds favor gap fill. And think about it. Even if whatever caused this action was truly bearish, Goldman Sachs and everyone, all the big money wanting to go short, if you get a gap down after a bearish kicker after the market already sold off, do you really think Goldman Sachs wants to sell down here? No. They're not. They're going to do the only thing they're going to be selling is what they have to sell, triggering system stops and so on. They're going to do the best of anything to bid the market up, then sell it when you get back to the prior day's close. Right? This is a much better place to sell than down here. So big money does not like to chase. You've got to remember that whenever you're evaluating these setups. Ask yourself what would, and I'm just picking on Goldman Sachs, but if you were at Goldman Sachs and your neck was on the line every day, are you going to chase and trade like a rookie just because you get a scary gap down? Not if it's moved real far, real fast. You're going to wait. You're going to do your best not to panic and wait for a better opportunity. Inverted hammer, same concept, just below the 10-day moving average. 50, well, no, it's not 50-50. It favors a gap up the next day. These have pretty good chances of filling their gaps. Down gaps, this is a bearish pattern, just like on the shooting star. Down gap doesn't do well. Remember, profit factor less than 1, it's lost money. So down gap after an inverted hammer, same thing. Even though it's in the direction of the trend, big money may be, continuing to drive things down. So let me get a couple more questions. How do I treat the gap of individual stocks that occur with the general market direction? I would trade, first off, you need to know, and their websites, I've seen them, I don't remember them off the top of my head, but you can find the correlation of a given stock with a given index, like the NASDAQ or the S&P or the Russell. And if your stock you're trading is highly correlated with these individual indices, like any technology stock is going to move generally in large part based on what the NASDAQ's doing, Apple probably being the exception, then you can trade using these index-based probabilities for that individual stock because they're moved more or less in lockstep. What percent win ratio and profit factor do I personally use in my guide? I'm looking for, I'm very, very rigorous, very intense. The stuff I do at Master the Gap, I have daily probabilities, multiple systems across all 8 markets. I'm looking for an average of all my systems to show there's at least a 60% minimum win rate, at least, bare minimum, across all average on my systems historically. So the setup I'm trading has had a 60% win rate, and it's had a profit factor of at least 1.3, meaning it's made at least 30% more than it has lost. Let me see other questions. When do I entered the trade at 9:30 a.m. Eastern time for gaps? So I'm going. Hold on. Back. Clyde had a question. Candle patterns showing reverse patterns. It makes sense the gap is the same direction as the current trend. The close the gap makes a lot of sense that they close. Is that correct? Gap is the same direction as the current trend. Yes, unless you're getting into sort of an exhaustion phase. So the market's been trending down and you get a gap down. If the market's exhausted, that gap will fill, but sometimes it'll just continue and becomes a little bit riskier. But in general, big money doesn't want to chase. So even the trend is down, to get a gap down, big money's going to wait till it gets back. They're going to bid it up and fill the gap. And vice versa, if the trend is up, you get a gap up. I've been doing really well shorting up gaps during this raging bull market. Let's see. Susie says, it would really help me if you could please show actual stock chart examples. I don't have, I can do some of those at the end, Susie. I don't trade individual stocks. I'll show you the individual ETFs or futures indices. We can do that on actual charts, but these are just candlesticks. It doesn't matter if this is red or green, red or green. And let's see. I'll get to what I'm doing in a second, Steve. But I'm using a stop equal to 30% of the 5-day average true range. The S&P gaps. There's about 15 to 18 tradable gaps per month. I think on average is 18 out of 22 trading days a month. So sometimes you'll have 20. Most days you've got a gap of at least a point or 10 cents. These stops, well, all this data for prop factor is using an end of the day stop, which is not something I recommend nor that I do. I use a stop equal to 30% of the 5-day ATR. The question is the 70% stat the same for gaps due to earnings as it is for general gaps? Yes. I should say for the indices. The indices during earnings season still have about a 70% win rate. Fear and greed don't go away. For individual stocks around earnings, I don't know. I certainly wouldn't trade a gap following earnings expecting that 70% number to hold, but I don't know that. I haven't studied it. The average gap fills in an hour and a half in the indices. 1 hour and a half is the average fill time out of a 6.5-hour day. So pretty much in the morning. That's another great tip. If you're in a trade or you're waiting for gap fill, if it hasn't filled within 2 hours, odds of it filling go down. Now today it filled later in the session. I think it took more than 2 hours. Any correlation of gap fill with increasing, decreasing volume? Gary, there probably is, but I haven't found it. I've studied done a fair amount of research on volume, and haven't really. I don't know if it's the data for volume has been kept as rigorously by the CME and the brokerages as raw price action. That's one of my suspicions. That's why maybe the data's not as good, but I haven't found it. I don't know. John says, appears you're not looking at stochastics. That's exactly right. I haven't looked at stochastic in many, many years. This data here is specifically looking at a bubble below the 10-day moving average. But to John's point, or what I think he may be talking about, if you're greatly oversold below the 10-day moving average, then it's going to be riskier for an up gap and more reliable for a down gap, right, just in general, and vice versa. Versus if you're just barely below the 10-day moving average, then, up gap's probably got a better chance of working. Does that make sense? So the degree to which you're overbought or oversold does play into, I guess, my interpretation of visual interpretation price action. But again, I'm looking at just hardcore data. Don't know. I haven't traded options on Apple, so conceptually, yes. It looks like the most profitable trades are fading gaps against the long trend. I'm not sure what you mean by the long trend, but in general, if the trend is up, shorting up gaps is a safer strategy. If the trend is down, buying down gaps, because big money doesn't want to chase. Can I assume that you would not use these small candlestick data sets because of terribly small sample size? Some of these I would not. Anything more than 20, 25, I'm going to trust more than anything less, right? Some of the data points, 30 and 40, absolutely trust them. But I don't trust anything on its own, ever, nor should you, ever. You want to layer in multiple data points, multiple considerations. My decision, I spend probably an hour each morning, a full hour, evaluating, and I've got tons of research already done, evaluating each gap. Just one gap in the S&P 500 each morning, whether or not I'm going to fade it, what I'm going to do. I spend an hour preparing for one single trade. What is the trade for tomorrow? I don't know. Haven't gotten there yet, Zach. Odds favor, let's see, a gap up. If you look at my video on my website, a gap up tomorrow is a much riskier trade than a gap down. That's just one data point. I haven't looked at my core research yet. I follow the 4 U.S. markets. In fact, let me just keep going. Wrap this up. So, I'm not trying to brag, but more to point, because again, I know that I'm not God's gift to the trading world or anything goofy like that. I trade on the right side of history. This is an actual gap-only trading account. It was a smaller account, but it was only gaps. My count here in like 15 or 16 months from here to here. This was the bottom. This little peak right here coincides with the bottom in 09. So this is what the market was doing when I doubled my count trading the gaps, trading gaps only. You see it went through a little blip as the market bottomed here in spring of 2009. At that point, I doubled this account and made it a more sizable account. So I reduced my position size in half. I just went to using less leverage. So this sort of is a little bit distorted. It would have looked more like this had I not done that. But the key point here is that the trend is still up, even though the market went way down and way up. I'm looking at my primary consideration, which don't have time to get into today. I'm coming up on the hour. Is the opening zone. I look at where a gap occurs relative to the prior day's open, high, low, and close. So where in that candlestick. And I've got tons of research on those odds for that. And then I evaluate that zone based on current market conditions, which is basically short and midterm. I'm looking at 2 to 8 weeks of data here, patterns, 3-day patterns, and seasonality. I actually look at day of week as a really important consideration. Tomorrow's a Friday. It's generally a good day for shorting up gaps. Now, tomorrow is also the 5th of the month, which is an oddball day, but it's a risky day of the month, reasons I cannot explain. It's also day of the monthly jobs report, which can add some volatility. So I'd be cautious tomorrow, but gaps on Fridays historically have done well. But I'm looking at multiple filters, and that's all I do. And I use historical analysis. I'm not looking at stochastics. When I say filters, I'm really looking at price-based patterns, not volumes, not indicators, just looking at, did we rally for 3 days or sell off for 3 days? Have we been rallying for 8 weeks or selling off 8 weeks? Have we been up, or down, up, down? Is it a Monday or a Friday? What zone are we opening in? Whoops. So you can learn more. Some of the stuff I do, unless you've been trading a while, may overwhelm you. The most cost-effective and time-effective way to learn more, if you're interested, about gaps, about probability trading, is to go to this page that, again, I've goofed it up. It should say www.masterthegap.com. Let me just fix the darn thing here. Tell them how many people I've goofed up here on that, and I'm really sorry. You can download a copy of these slides. I've got a bonus presentation on 8 facts every trader and investor, 8 gap facts every trader and investor should know. It's free. More good information that's not candlestick based, but based on just factual data points you need to know and understand as a trader. And the most time and cost-effective way is to take advantage of a DVD offer. I don't make a bunch of money on these folks, but let me just show you. It is by far the best way for me to get you up to speed and get you exposed to what I do. And we do have an offer here, so let me pull that up. Going to masterthegap.com/candlesticks. Okay, so when you go here, enter your name and email address. You'll get the slides, this bonus presentation I was just mentioning, and then you got to scroll down. It's important that you do this, so everyone please pay attention if you're interested. I've got 5 hours of research and data, and I break it down real basic. I've covered a lot of ground here in 1 hour, and I know I've lost some of you, and my apologies, but I try to balance valuable, useful, tradable information with education. It's hard to do sometimes. But I've got the opening gap DVD set, and then profiting from the opening gap, which really gets into more of the research. So the basics and the research. It's normally $500. If you click there, you can learn more and see some silly videos. But a professional moderator with me. Spent a lot of time putting this information together. They're normally $4.95. If you order, let me go back to one thing. If you use Pay97, special coupon codes. I know I'm going to get a bunch of emails on this. Please enter Pay97, hit order now, and oops, you can read more there, but go to order now again. This is where you enter the special code, and you can get it $97. So again, I'm not making a bunch of money on this. This is just a great way for you to figure out if gap trading and probability trading would be something that would be helpful or complementary to what you're learning or whatever other trading techniques you're currently using. A lot of folks follow me all over the world. I have hundreds of folks that follow me. Some follow me as sort of the go-to guy for trading the gap and opening ranges. Most people use the information in concert with other favorite indicators, favorite techniques, what have you. So I have several different brokerages that I use. You can use this information with any brokerage firm, any charting. It's just information. I'm a mathematically oriented trader. Those trade results, so let me go back to questions. In fact, I will answer what to do tomorrow. If you want to hang in there, I'll save that at the very end. I'll show you my actual research because I haven't looked at it yet, but I'll show you the research that's posted for tomorrow. What is a comfortable risk-reward ratio to aim for beginner, intermediate, and experienced trader? That's a really individual thing. I could make more money trading, bigger returns, if I accepted a lower win rate and held for bigger runners, if you will, held more through gap fill. But I'm not comfortable taking a lower win rate. So I have, with a 65% win rate, it depresses my how much I lose, controls that, but also controls how much I stand to make. But Zach the Ripper, I'll talk about the trade for tomorrow if you hang in here. All of my examples were daily charts. Every chart or every daily bar is 9:30 to 4 o'clock Eastern. And I focus on the Russell, Dow, NASDAQ, and S&P. I primarily trade the gap in the S&P. It's the most liquid. It's the big daddy. I wouldn't trade against it ever. Occasionally I'll trade ranges, 15-minute and first hour ranges on the Russell. There's no advantage to trading the Dow or the NASDAQ versus trading the S&P in my mind. Russell, more leverage. You get it has bigger profit opportunity per day, but you can also lose more per day. So I think the S&P is the best one. My testing actually shows it most consistent as well. Gaps work well in silver futures. Henry, I haven't tested silver. I'll probably have at some point, but not in a long time. I don't remember. You do have gaps in commodities like gold and oil, and I'm sure silver as well. And you can fade gaps and follow those gaps as well. I actually teach people how to create their own gap trading strategies. If you're interested, check out my website. My 10-day moving average is indeed a simple moving average. I will use EMAs on intraday charts, but I like the simple for day charts. But to each his own. There's no right or wrong. It's a simple moving average. Once the trade is open at 9:30, how soon do we know if there's a chance to gap fill? I hold some trades to all day. If it's a historically strong setup, I will enter at 9:30, and I prefer the ones that fill quickly, but sometimes I'll hold on to the trade all day. How do I scan an individual for gap equities? I don't. There are a lot of services out there that'll show you gapping stocks. You can set it up in TradeStation really easily to do that as well. I just watch the futures. My trade results are actual. What I just showed you, that's my actual own trade results, and I'm not trying to say that I'm all that or anything. I'm very proud of the fact I'm one of the more consistent traders you'll ever meet, I think. But it's only because the market conforms to history about 65% of the time, which is exactly my win rate historically. Those are actual trade results there. Let me continue with questions. Pay 97. Pay 97 does work. Let me show it to you again. I've already entered it here, but if you enter Pay 97 and hit Apply Code, it will change the price to 97, and you show that. Glad it was helpful for you, Cal. I'm looking at 5-minute charts intraday, just on the day's chart. You're welcome, Carol. JapaneseCandlesticks.com. Sorry, it was hard to understand the tips. This sounds self-promoting, but honestly, I've got too many. I'm very good at responding to emails, but I've got 4 daughters and a great life, and I'm involved in my community, and there's only but so many hours in the day. So my DVDs I put together specifically to take you from A to Z on the basics. I think that's for $97. I think you'd be hard pressed. Oh, and by the way, it's a money back guarantee if you didn't see that. It says it's somewhere in here. Oh yeah, there it is. Money back guarantee, right in front of me. So you can't lose. Continuing down. Oh, great, Tony. Glad you like the DVDs. If you're not a mathematical type person, can you master the gap? Yes, Mike, and I hope you don't take this wrong. If you are not a mathematical person, you are going to struggle with trading, period. It's just a matter of time. You may be killing it right now, but if you don't train your brain to use, again, I'm not at all talking to you, Mike, but I'm preaching to the masses here. It's 7th grade math. It's probably more like 5th grade math, to be honest. I have a 5th grader, and she can understand all the math that I do. Literally, everything I show to my members is 7th grade math. It's simple ratios of win rates and average size win and average size loss. So you need to, we teach you, if you're interested in signing up, again, I'll start with the DVDs, but you get 4 hours of training information once you sign up if you decide to do a trial. My stop loss number, again, is 30% of the 5-day average true range with a minimum of 5 points in the ES, 50 cents in the spider. Ralph, if you're fairly new to trading, I would absolutely stick with Stephen and milk Steve Bigelow for all he's worth. He's excellent. His book was excellent. It was very instrumental in my own trading. And then I would just follow the path that his training takes you. I mean, again, I do things very differently than him, but I'm not here to browbeat you into joining me or buying my DVDs, and that may sound like it. I am taking family time away here, so I do hope some of you buy some DVDs. But I'm a big believer in you have to follow your own gut and instinct, and with one exception. If you think you can look at charts without rules and make on-the-fly decisions using your gut, you are screwed. What I love about Steve is that he gives you simple rules on when to buy and sell. That's a great place to start to learn how to trade, and then you can layer in some probabilities as you get more comfortable and want to improve. I don't trade options in the SPY anymore. I have several members that do, that I know. I have quite a few folks use the double and triple leverage funds, the direction. Yes, you can absolutely trade the leveraged ETFs in both directions as opposed to futures and do very well. Oil is a good one to trade. I've done some research and helped folks in creating oil strategies. You can fade and follow gaps in oil, gold, GLD as well. All my research, all the markets, the equity indices are so correlated that this information is going to be helpful for you as long as the stock generally correlates well with the spider, for example. The assumption here was that you closed above or below the 10-day moving average. It has nothing to do with where the actual gap occurs. It's a good question. It's a subtle note. We look at all my research looked at, did we close above or below the 10-day moving average, and get the candlestick pattern that I just showed. It has nothing to do. The open could be on the opposite side of the 10-day moving average. Great question from Steve. Would accepting a 50% gap fill greatly increase one's profits across the various setups? No, and no. It's a great misnomer. A lot of educators that like to tell people that's what they do. They're doing it out of fear and ignorance, in my opinion. So sorry, that's a strongly worded statement. Ignorance in the sense that the data shows, when I've done back testing, you have an 85% chance of 50% gap fill. You have a 70% chance of full gap fill. So do the math on that. Would you rather have an 85% chance of making, let's say, 50 cents, or a 70% chance of making $1? I'll ask it again. Would you rather have an 85% chance of making 50 cents on the spider, or a 70% chance of making $1? If you don't know the answer to that question, then you really you need to buy my DVDs. This is Trading 101 around profit expectancy. The profit expectancy is going to be much, much higher going for full gap fill. Okay? So I encourage you to fight off that desire to take some profits at half gap fill. With one exception, if it's a large gap, more than 40% of the 5-day ATR, then yes, go ahead. You can take some profits early because the larger gaps have a much lower chance of filling. Markets conform to history 60% of the time. Do you have a reference to read, or is that your data point? My win rate 65%. So technically, it's probably more like 80%. The markets conform to history 80% of the time, and through my execution, there's some slippage and things that just don't always work out. I win about 65% of the time. The key point there is that roughly, just think of it this way: a third of the time, even if you have a great setup, it's not going to work. That's the key takeaway. Even if it's a strong historical setup, a third of the time, it's not going to work. I do daily videos on my website. You can sign up. It's free. It's a pop-down box when you go to the Master Gap website. I'm trading futures contracts. I'm still catching up on questions. Sam, that was Dan Marina. I don't think it's Dan. Yeah, that's not me, by the way. My picture's no better, though. I'm looking like I just put a lemon in my mouth or something. The $97 code is shown on right here. So you got to go down. This is the mastergap.com/candlesticks page. Scroll to the bottom, pay 97. You're not going to find that anywhere else. Pay 97. I don't care if you post it all over the web or tell your friends, whatever you got to do to remember that. I'm trying to make it a lowercase p, but there we go. Pay 97. You can go to the link that I've shown many times, and trade the opening gap and profit from the opening gap. Tony Marino, that's it. Tony Marino. Their gaps occur on average about 18 tradable gaps per month. Folks, I'm going to need to wrap it up. I've gone an hour and 15 minutes, and I want to be courteous to Jim and Steve and Becky, who've been so gracious and allowed me to present to you tonight. Slides downloaded are not presentation. Can you get his attention? You have my word that you will get those slides. If you didn't, email me, Scott. Pretty sure I'll double check that. There are 2 slide decks, though. There's 2 presentations. One is the bonus presentation, so maybe that's what you're looking at. Double check your spam folder. If not, you can shoot me an email, scott@mastercap.com. We'll take care of you. You will absolutely get a copy of the slides. So as long as you enter your name, I'll double check as soon as I'm done here. You'll get the recording from the Steve's folks. And I use TradeStation in my back testing. I don't care if you publish. My videos are public and available. I've done a 10-minute video every day for the past 5 years. I've got over 1,000 videos. All right, folks. Thank you all. I'm sure you'll have more questions. There is my email if you need it. Let me again leave you with one last thought. Go there, enter your name. You'll get a copy of the slides, the bonus presentation, and then scroll to the bottom and use Pay 97 if you're interested in the DVDs. That offer does expire on the 15th. I should have said that. It expires April 15th, so it does not last forever. You've got, 11 days or so. Oh, Zach the Ripper. Okay, super quick. Zach the Ripper. I got 1 minute here, okay? I'm getting the hook. Yeah, if you think you're lost now, then you need to leave because I'm going to show you my website and the research for tomorrow. So this is a worksheet. It summarizes the gap fill probabilities across all 8 indices, both futures and ETFs. And here's the key takeaway. Just trust me, I don't have time to explain this. A gap up is generally a pretty good technical setup. You see, especially if we open between the high and the close of today's prices. So a gap between the high and the close has a 70% historical win rate across all 4 U.S. futures and 4 ETFs, and a 1.5 profit factor. Make 50% more in profits and losses. There are some risks, though, and it's a small sample size, but this 5th of the month during bullish markets has been a dog for trading. Monthly jobs report has actually been okay. So you can pretty much bet that I will trade a small gap between the high and the close. This is a strong number. Win rate's too weak here if we open above the highs for me to trade it. Gap down is neutral. I'll have to look at this other data. And a gap down below the lows would be terrible. So these are just opening areas. The buy site you need is, one last time, www.mastergap.com/candlesticks. Folks, I got to go. I do daily videos. You can check us out. I know a lot of you prefer to see an actual chart versus my candlestick drawings on. The information is still exactly the same. So maybe if you go back through the slides, I do nothing but live charts on all of my daily videos if you want to check those out. So, and with that, good evening all. Thank you to the Fine Bigelow folks and to Steve, and good trading. Take care.